All righty. So welcome everybody. If we could just do a few housekeeping things, you could keep your microphones muted and your video cameras off for today. We will have a Q&A session at the end where you can unmute yourself and turn your cameras back on, but we are going to try to record today's session so we can share it with additional individuals who are not able to be with us today. So it helps keep my speaker portion of the video on the recording and not bounce around. So if you could just make sure to keep your video off and yourself muted during the session, and I'll let you know when you can unmute yourself and we can turn on video and definitely chat if you have any questions towards the end. You are also welcome to utilize the chat function during the session. If you have a specific question that you'd like me to address while I'm going through the slides, feel free to use the chat function and ask me your questions, and I will try and address them as we go through the presentation. So welcome. Today we are going to be talking about understanding association financials. And our goal for today is to really share with all of you, accounting basics. We're not expecting for any of our board members or treasurers to be experts or CPAs. We want you to understand the basics of the transactional portion of the work that we do and understand the reports that we are sending to you on a monthly basis. What are some of the key indicators that are in those reports that you should be paying attention to? And really to educate you about how to spot and how to be aware of fraud. We have a lot of controls in place to ensure that that type of thing doesn't happen. But as a management company, our goal is always transparency. And so we're going to talk a little bit about that as well today before we close. So a few key takeaways, and for those on the call today and watching, we will be sending these slides out to you after the presentation, so don't feel like you have to take notes on all of this. We will distribute the slides out to you for future reference. But our key takeaways, what we really hope that you walk away from this training with today, are sort of listed on the screen, and understanding, the difference between your role and our manager's role. What are some key advisors? What are your reports that you should be looking at every month? And what should you expect from a financial perspective as you move throughout the year as a community? So the financial basics of a community, and these are sort of what we would consider to be the buckets in which the board of directors deals with on an ongoing basis. And so the foundation for a community's financials is going to be your budget. Your budget is going to establish from the get-go what services your community is going to be administering, what responsibilities they have to carry out. And your budget is going to include the basics of what income you have coming in and what expenses you have going out. Your reserves are going to be anything from 2 to 30 years. So Oregon state statutes require that as a board of directors, you're preparing a budget annually, and that you're looking at your reserves on an annual basis. And your operating expenses in your budget are anything that happens on an annual basis. In a 12 calendar month or in a 12 calendar year, what are we paying every month and what services need to happen every year? Your reserves are expenses for your common area maintenance that happens between 2 to 30 years. So it's a longer range planning tool that says, these are the assets that the association owns, and this is how we're going to maintain them. And we're going to set money aside every year to make sure that when we need to maintain them, that we have the funds to do so. And so your budget and your reserves definitely work hand in hand together, but they are two separate tools, and they are looked at a minimum of annually. And then your reports, your financial and your monthly reports, are sent to you on an ongoing basis to show you how you're tracking with that. what operating expenses are we on track with, and what reserve expenses did we expect this year and are either happening or we might need to defer to next year, and how is that process working for us? A few things to understand as a board when you go to start looking at your budget and how to approach the process is understand a few basic state statutes around budget. So your budget has to be adopted annually, and it is required to be sent to your owners 30 days before going into effect. So pretty good timing to be talking about this right now. Our managers are working on your first rounds of budgets. You will likely, either you have scheduled or will be scheduling your budget meeting here to happen in October or November, because by December 1st, we need to make sure that all of those budgets are out to your owners in order to comply with the state statutes. And some of the things that you are going to be talking about during this process will be discretionary. What do your owners expect? So for example, if you have front yard maintenance as a requirement in your community, you may have conversations about, do we want a more basic maintenance contract that fits within a certain financial parameter that we're trying to achieve? Or do we want a little more manicured contract that meets the owner's expectations and maybe costs a little bit more? And so you're going to start with what are the responsibilities of the board and the community, but you will then also want to have some conversations about what are the owner's expectations around some of these services that are being delivered to them. Our budgets, unless you are in a very rare scenario, your budget's always going to balance. You're going to set your expenses and your assessments are going to be established through those expenses. If you have $10,000 in expenses, you're going to need to bring in $10,000 in income. None of our communities are generally running at a deficit and generally not at a surplus either. You want to make sure that if there are some contingency factors, we're building those in, but you're always trying to work towards a balanced budget. And I explained a little bit of the operating versus reserves, but these are going to be sort of the four key main areas that you're going to discuss when we talk about the budgeting process. So here's kind of a basic budget on what your, this is kind of an industry standard. This is actually from CAI, Community Association Institute, to establish what a budget kind of is going to look like. Ours are actually going to show you 12 months. So you're going to see when those expenses are going to incur within that calendar year. So you're going to see a January through December columns, along with your annual totals and then your assessment calculations on there. But this is the basics of what is contained within a budget. You are going to have your general ledger items that are going to be over here on the left-hand side of the screen. Most of our budgets are going to show you the correlating GL or general ledger number that goes along with that line item. For treasurers that are on the call, this is where you're going to see then in that monthly set of financials, the expenses that you're seeing paid are going to correlate with those budget numbers. You're going to have your expenses down here in this section, and then you're going to have your corresponding operating assessments and reserve assessments up here. Generally, most communities don't look at other income as revenue sources, so you're not generally going to see that we're budgeting for late fee income or fine income, interest fees or anything of that nature, because those are not known or fixed income. So you won't generally see budget line items for those, but you will see them tracked on your financials. And your replacement reserves. So the reserves, this is sort of a very basic understanding of what your reserves look at. So your reserves are going to look at every asset that your community owns. It could be anything from asphalt to concrete to roofing to play structures. You could own buildings. If you're a townhome, you might be responsible for exterior maintenance of those buildings. And so your components are going to be the things that your association is responsible to maintain. And that list is going to be in line with what your CC&Rs say. So your CC&Rs are going to establish what those requirements are. And then the reserve professional that you're hiring to prepare that study is going to provide you with everything sort of over on this right-hand side of the screen. And they're going to provide you with what is the general estimate useful life of that item. So when we're talking about asphalt, this one's a little conservative that you see on the screen, but asphalt, generally the useful life here in Central Oregon is 20 to 25 years. And so you would see that that component will have a replacement requirement within that time frame. And you're going to have what that component currently costs to replace and what you need to contribute towards that component in order to have the money to do that based off the useful life. There's also a calculation that is placed on this of inflation and contingency. And so if it costs $10,000 to replace it right now, you're generally going to see that a 3% contingency and a 3% inflation rate is applied to that component, which will then give you what the projected future replacement cost of that is. And the theory behind replacement reserves is then you divide that by the remaining useful life, and each year you set aside that money to make sure that in that 20th year, when you come to replace that component, the dollars are in your reserve account to do so. And so what you see in the budget essentially is that this member income that you have up here is going to take care of all of the operating expenses, but it's also going to take care of your reserve contribution for that year. And that reserve contribution may include some dollars that you're going to spend that year, but it's generally forward-looking in what you're setting aside. So we've got budgets and reserves. And then when we start to talk about the monthly reports that you then see generated from that work. So your board establishes the budget, you adopt the budget, and you adopt your reserve study on an annual basis. And then we as your management company take that budget, it's put into our system, and the monthly expenses are tracked throughout the year. And it's important to understand how we produce those reports so that you as board members and as treasurers understand what you're looking at on a regular basis. So our reports are all produced under GAAP, generally accepted accounting practices. We work with several CPAs and go through financial reviews and audits on a regular basis to sort of test our protocols and make sure that we are in line with those generally accepted practices. And the accounting that we produce, there's sort of three ways of distributing information when you talk about transactional-based accounting. So you have cash-based accounting, which is effectively you record the money when it comes in and you record the expenses when they go out. You don't accrue any of those expenses or assessments, and it's really just a snapshot, a look of exactly what's happening at that given moment. You have a modified cash basis, which all of our financials are prepared under what is called a modified cash basis. And what this means is we are accruing your income, meaning that we post all of your reserve or all of your assessments at the point in which they're due. So for your assessments, if you have them on, say, an annual cycle, for example, that annual cycle would mean that on January 1st, we are posting the assessments to all owners and sending them their coupon books or their statements. And on your financials, you are going to see that if you expected to assess your owners $10,000, that $10,000 is going to reflect as being charged to those owners in your monthly reports. what you will then have to do is compare that to your accounts receivable aged report and see how much you have actually collected, because the accrual of that means we've posted all of it, but it doesn't mean we've collected all of it. And the reason that it's a modified cash basis is your income is accrued and your expenses are on cash. So when we receive an invoice, it is expensed into your general ledger. Accrual basis is full accrual accounting, is accruing income and accruing expenses. With the basic transactions that associations are doing, this can be a little bit overkill. You may have a complex community where this is necessary, but none of our clients are currently doing full accrual. And the difference for full accrual between a modified cash would be that if we didn't get a landscape bill for, say, within a given month, we would go ahead and accrue that expense. And when that invoice came in, it would require some entries to get that paid. And so we do operate our expenses on a cash basis, but our managers certainly try and make sure that we get as many of those expenses within the budgeted month period that we can. And so your monthly reports are going to consist, you're going to get the full gamut of reports. And those reports are going to include some things that you might not pay attention to. The treasurer may drill down into them a little bit more than the rest of the board. But at a minimum, what we're going to go over with you guys today is to make sure that at a minimum, these are the reports that you're looking at every month and that you understand what you're looking at. So the first piece of information that's going to be in your financial report is going to be your balance sheet. And your balance sheet provides a summary of really where you are as a community from a financial perspective. And there are three major components to that balance sheet. You have your assets, you have your liabilities, and then you have your equities. And your balance sheet is always going to do exactly that. It's always going to balance. These three categories have to balance against each other. If your balance sheet is out of sync, it means that we've got an adjustment to make something's gone a little wrong. And so your assets are going to include things like your bank accounts and any accounts receivable. Because we are accruing your income, the accounts receivable is money yet to be paid to the association and is considered an asset. Your liabilities are going to be any accounts payable that are in the system that haven't been paid. So sometimes at the ending of a month, we may not have gotten all the way through the approval process for an accounts payable, and you might have to, it rolls into the other month and the next month. And so you have that pending accounts payable on there as a liability because it's something known to the association that you haven't yet paid. Prepaid assessments are seen as a liability, and the reason for that is that, should something happen and the association dissolved, which is super, super rare, but if it happened, you would have to pay those funds back to the owners. And then your liabilities or your equities are essentially your assets less your liabilities, and it sets sort of your retained earnings as an organization. Have you made money over what you expected to pay, or have you lost money and you are, in the hole within that given snapshot? And your balance sheet is really a snapshot of the given moment when it's printed. So generally it's going to be at month end, and it just shows you at that point in time when we are printing it, where you are as an organization. Your income statement is going to provide you with a record of, sort of everything that happened in that month. You're also going to see things like a budget comparison. So you're going to see your monthly transactions for that period compared to where you are year to date. Your income statement and your budget comparison report are probably the two reports that as board members you're going to pay the closest attention to. This tells you, based off the decisions that you've made as a board of directors, are we tracking with the budget that we've adopted? Are our landscape costs on track for the year? Are we bringing in the income that we expected? And are the expenses on track with where we thought that they would be? And, the bottom line for you is going to be, where's our net income? are we over where we expected or under where we expected? Certainly, if you are losing money, that is something as a board member that our quarterly financial narratives will explain to you. Where are we seeing expenses track higher than we expected? Do we project that that's going to continue through the remainder of the year? Or do we potentially have a problem where you might have to find ways to cut other expenses to ensure that you don't wind up in the hole by the end of the year? And so our quarterly financial narratives are going to track that for you as a board and prepare you some of that information so that you can make reasonable decisions. And if you ever have questions about that and sort of where you're at, reach out to your manager and make sure that you understand where you are going to wind up within that year if you have concerns. Your monthly reports are going to consist of the following list. You are going to always get your balance sheet. You're always going to get your statement of income and expenses. You will see an aged owner's report in there, which is your otherwise referred to as AR. And you're going to see the aged accounts payable. So any of those accounts payable that were in the system at the end of the month before we close the books. And there could be various reasons for that. Sometimes we don't have vendor insurance that's current, so we may be holding payment on a vendor and to make sure that their insurance renewals come in. We might not have W-9 information on them if they're a vendor that is new to your community. We always make sure that we get those W-9s before those payments are made. And that is in compliance with IRS regulations. It's also where you will see that we file the 1099s for you at the end of the year. And so that process has to do with making sure that information on certain corporations is reported to the IRS on the income that was paid to them throughout the year. And so there could be various reasons why there is aged accounts payable. And if you ever have questions, again, always make sure you reach out to your manager. Your trial balance or your GL detail. So this is a report that as a treasurer, you may want to look at every month. This is going to tell you every transaction that happened in each GL category throughout that time period. And it's definitely more information than a general board member may want to drill into, but this is going to give you all of that detail on if we spent $12,000 and we were set to spend 10, you can go to the trial balance or the GL detail and see where did the other $2,000 in expenses come from, because it's going to show you every one of those transactions. And then you're always going to see your bank reconciliation report, and it will include your bank statement. And that's important. Many times we've heard of fraud cases, and a lot of times that comes from board members not seeing bank statements, not having visibility into that, and we'll cover that a little bit later in this presentation. But your monthly reports are always going to include a bank reconciliation. So a couple of things to make sure that you are looking at on a monthly basis. So managers are in the process of sending financials out right now. You might have already got them or should be getting them in the next couple of days. And when you get that report as a board member, when you open it up, if you have 10 minutes, what should you look at? These are the key indicators that as a board are going to provide you with a little bit of information to know, should I be asking other questions or are we in an okay place? And, looking at your balance sheet, is your cash position still relatively the same as it was in prior months? There may be some reasons that it wouldn't be. If, for example, if you are an annual assessment and you only bill your owners one time per year, you may get in a bunch of cash in January, and then as you pay those expenses throughout the year, that would dwindle. And so cash position isn't always going to necessarily tell you that there's something wrong, but it is going to make sure that you understand where you are as a community. As I mentioned, that budget comparison spreadsheet or that budget comparison report, that is going to tell you where you are within the framework of the year. So if we adopt a budget in November of the prior year and we're halfway through the year, are the assumptions that we made for that year 6 months ago, 8 months ago, are they still tracking, or have we seen some unforeseen expenses? Reserves, your reserve balances are going to be reflected on your balance sheet. depending upon the level of cash that you have, you may have those in long-term investments. How are you tracking on that interest? And then delinquencies is going to be a key indicator for you. Are we suddenly seeing a big spike? Are we seeing a change in how many owners are delinquent? Are we starting to see a trend in foreclosures? This is certainly something that we are paying attention to within our current economic climate. We haven't seen a big spike in foreclosure or in delinquencies in our communities just yet. There certainly is some concern in the industry that given the level of unemployment that this is going to change, that we are going to start to see an increase in aging AR and potentially some foreclosures. There's certainly some news around defaults and banks sort of setting themselves up for some potential losses. And so this is something we're paying close attention to, but as a board member, if you look at nothing else, look at your balance sheet, your budget comparison, and take a look at your aging AR and understand that month from month, if it's growing or shrinking or where you're at within the projections that you have set out as a board. So some banking standards that are important for you as a board to understand. And these are things that we take it is very important to us to make sure that we are acting in good faith with your bank accounts and your dollars. The money that we help handle for you is the association's dollars, and we're acting as an agent. And it's important that every month we transmit this information to you in a transparent fashion so that there's always transparency in what it is that we're doing. So that fiduciary role is very important to us. So a few things to understand. Under Oregon statute, you are required to keep your operating and your reserves in separate bank accounts. So you cannot commingle those funds. You will see those in separate bank accounts on your balance sheet. You may also have things like a working capital fund for some communities, or you might have a special assessment account, things of that nature. We're always going to try and list those out in separate funds on your balance sheet as much as possible. Your operating checking account is a high transaction, so it has the ability to write as many checks out of that as possible. What that means is it's generally sort of the lowest interest earning account. And your reserves are generally in a money market account, and that has a restriction of the amount of checks that we cut out of there per month. So on occasion, if you have a community that has a lot of transactions that come out of their reserves, you may also see that you have a reserve operating account, and that will be a high capacity checking account that allows us to cut more checks out of it. But if you are in a reserve money market account, you are restricted to the number of checks that you can cut out of that, and it generally comes with a slightly higher interest rate on it. Interest rates aren't great right now, so we're not talking about the difference between 3% and 6%. We're talking about a couple of basis points. Investments. So if you are a community that is holding cash that is for future replacements that builds to a substantial amount. So for example, you may own all of your roads. You might be holding $500,000 or $1 million for future replacement of large portion of that asset. It's prudent to potentially look at how do you invest that to gain the most return on that. But it's important to understand that Oregon statute requires that it be in principally secured accounts. So you cannot take association dollars and go place them in the stock market. You can only do that in principally secured investment vehicles. So you're kind of restricted to CDs or bonds. Neither have fantastic rates right now, but it does give you maybe a point or half a point more than what you might earn in your money market account. We utilize a lockbox service to process all of our accounts receivable. This is pretty common in this day and age. If you send in your electric bill or your water, your garbage, any of those things, they're all utilizing lockbox services to sort of divide who is handling what. Provides a separation of duties in that our office isn't handling checks. We don't have access to account numbers or those types of information that we're handling. We can't access copies of them, of course, but we are not accessing the process. We are not processing those checks here in our office. And so that is why you will see a mailing address on those coupons or statements. It is not to our physical location here in Bend, and is to a location of that lockbox. And it really ensures that that is done pretty quickly. Those lockboxes process the checks, and we get a daily download of those. And so the payments are processed fairly efficiently in that manner. And it keeps sort of the overhead cost of that, of having to have labor to process those things. And it's important to understand that your managers, when, if you have a cash flow problem, they're going to come and, talk about how can we close those gaps. And for a community, your levers to pull on this are somewhat limited. You're either going to raise dollars through a special assessment or an increase in assessment, or potentially you might look at seeking a loan that might close those gaps. And so those are always options if you're a community that has some cash flow issues. Warning signs to look at on your financials as board members. Again, our goal is really to educate you on these. In most instances, our managers, if you're a new client of ours and we're processing information, you may find that our managers are coming to you and saying, you don't have a reserve study and you really need one, and here's why. These are going to be things that our managers are well educated on, that they will dialogue with the board about. These, given our standards as a management company, are not generally things that you're going to see sort of go unchecked by our team. But it's important that you understand what these warning signs are, and that if you have a steady decline of cash for your community, what is that indicating? Are we seeing water bills go through the roof? Have we had our landscaper, hit us with an unexpected increase? There needs to be some explanation on this, and as a board, an understanding of it, this is going to continue, or should we make a change to this? Significant or unexplained differences between accrual, actuals and budget figures items are always something you want to pay attention to. Did we have an unexpected expense, or did we miss something? Increase in amount of owners' assessments owed to the community. That is certainly something that in your financials that it would be a red flag. Unusually large legal expenses. This is sort of something that we always educate owners about too as well, but this might indicate that there is something there to be disclosed, or you want to understand if the board is aware. If you have your president sort of potentially being the go-between for your attorney, your board needs to make sure that they understand what might be going on there as well. Absence of a reserve study. Your bank reconciliation report is going to be disclosed with your bank statement every month, and your bank statement is going to correlate to that reconciliation report. And that reconciliation report is going to show you why is there potentially a difference between what's in our bank account and what shows in the accounting system. And you're going to see anything that maybe deposits that hadn't been reconciled, or accounts payable that hadn't quite cleared yet. All of that is going to be on your reconciliation report. And, missing financials are always something that as a board member, you should be asking questions about. You should get your financials by the 20th of every month. And if there's ever any concern about that or missing months in there, you can always feel free to reach out to me. So the roles and responsibilities as we talk about accounting. So understanding that the role of the manager is to really be a bit of a generalist. Their role is to understand a little bit about a lot. And we talk about this in what our managers do across the board for their job, but it's even more so with the financials. They're going to understand what your vendor contracts look like, and, have a great amount of information as to how the day-to-day operations of your community is running. There's going to be certain things that you're going to want to bring in experts for. So they're going to understand the process of budgeting and reserves. They're looking at your monthly financials and understanding your collections. If you have owners that are in collections, you're going to see that on your quarterly narrative on what's going on with those, even if they're at the attorney, that explanation is going to be provided to the board quarterly. So our management, sort of looks like this. Our managers are essentially implementing your policies, overseeing day-to-day operations, taking owner communication, oversight of the vendors, and making sure that they're coordinating with your service providers and assisting the board in making sure that they have what they need to make decisions. And our accounting team is really doing the transactional side of things on a day-to-day basis. They are making sure your money is coming in and your bills are getting paid, and that process of the accounting behind the scenes is all taking place and getting done. And we are going to bring in individuals that might help the board with additional information when necessary. So understand that our accountants are not CPAs. We do work with outside CPAs on your audits and your financial reviews and your tax preparation. That isn't done here on our team. That's done by an outside vendor. There's a handful of them that we work with in our space, and our team is coordinating that, but that isn't what our role is. Our role is really to act as sort of the bookkeeper of the day-to-day accounting. And so, occasionally we'll bring in the CPA to talk to the board if they have questions about any of those things. Those aren't always things that our managers are going to be able to answer for you, but we will get you those resources. And your banker, your banker's really going to be the one that's going to come in and talk to you about investments, loans, those types of things. Our managers are not experts on those things, but again, they're generalists about it. So understanding those roles between what our managers do, what our accountants do, and then when are we going to bring in those professionals if the board has specific questions about those is important. So a couple of policies that are good to understand, and I'm actually going to stop sharing my screen really quickly, and I'm going to show you, since we have the benefit of being on a virtual call today, I'm going to switch over and I'm going to give you a quick peek of what our accounts payable system looks like, so that you can have an idea as a board member what you can look at, sort of what the protocols are, essentially, if you would like to have access into the accounts payable. So our accounts payable system, we use a system called Strongroom. And what this system does, it allows you visibility into the accounts payable. And so when we talk about policies around this, what we are referring to is really, as a board, you get to decide what the thresholds are for accounts payable. So for example, if you would like to have the treasurer approve everything, this system allows you the ability to do that. And when you log into this system, you're going to have access to a lot of information. You're going to have access to, you will only see your community's information, but you will see things like, the vendor, the general ledger that it's being paid to. You're going to see a copy of the invoice. So if you're the treasurer and you're involved in that process, then you can make sure that you have the ability to see that expense before it's paid. And as a board, you have the ability to decide ultimately then what you want to make sure what you have eyes on before it's paid. So the policy around accounts payable really has to do with what are the thresholds that we as your management company have to pay? What does the treasurer need to see access to, and what might additional board approvals need to, be implemented if it's, say, over $5,000, some boards want 2 board members to take a look at it. If it's an annual contract, then we can pay that. But if it's something that's a non-recurring expense, then the board might want to see it. And so as a board, you should talk about what you want your accounts payable process to look like. And then your accounts receivable procedure is really how you're handling collections. And so there's a certain, sort of desire by your board of directors on how you want collections to be handled, as far as, is it a 30, 60, 90 day communication and then we send it over to the attorney? You know, are there different processes that you might want to put in place? So understand that you have the ability as a board to adopt a process on your accounts payable as well as your accounts receivable, and your accounts payable is really communicated to your board so that we can make sure that those protocols are set up through StrongRoom, and your accounts receivable is set up through your collections policy. The other financial policy that the board might want to consider adopting is your investment policy. And the purpose of an investment policy is to really lay out what the expectations are of the board of directors so that usually the treasurer and the manager can make sure that that gets done. And the investment policy, you know, is somewhat limited when we talk about it for organizations of associations, because as I mentioned earlier, Oregon state law requires that they are in principally secured accounts. But what your investment policy allows your treasurer to do is to sort of cash flow potentially your reserves. If you don't need your reserves for 3 to 5 years, can we ladder those out into CDs and gain a little bit of return on those dollars and make sure that the principal is secured, but we achieve the objectives? And so our managers can help you adopt those investment policies so that your treasurer can put those into place and you can at least gain maybe 0.25% more on your dollars and earn some of that back for your community. So that is the basics of accounting, you know, understanding your role as a board member, what our managers are responsible to do, what the reports look like, you know, or what the information is that will be distributed in them on a monthly basis. So I am going to go ahead and stop sharing my screen.